It's in your review here, the mystery here of all this cash, and you talk about there's just too much cash out there. What do we do with our cash next year?
You've laid out actually an incredible introduction to what we're writing for this next year, which is called Slow Then Grow. And the idea is that you are going to see a slowing economy at the beginning of the year. A lot of the concerns that Lisa just talked about, actually could come to bear, right? Which is the economy slows down, but it does not crash. We do not have a recession. We do not have a V-shaped recovery. And because we don't have a clear signal to investors, they sit there in cash. $5.8 trillion worth of cash at this point in overnight funds. It's extraordinary. And yet, when you take a look at all the different parts of the economy, right? You take a look at the average stock in the U.S. hasn't done that well. 10 stocks have done incredibly well. Bond market's already started to move. Energy is down. You are seeing real signs that inflation is not an issue and that the Fed will hit their target of 2 to 2.5% by the end of the year. So if that's true, right, what you then need is a boost of earnings, right, in order to believe that all of this comes together. And this is where I think the story is being missed by the average investor, is that in the U.S. you're going to see ambient-like earnings up by probably 5% this year and then 8% in 2025. And that sets us up for a thing where, an opportunity where a balanced portfolio, right? You put your money in bonds and you put your money in stocks, and you sit there and you're patient. And over the next 18 months, you can get yourself a 15 or 20% total return. Now you're giving me the skeptical look, Lisa, right?
I'm just interested.
Here's the interesting data point. In 1931 and in 1969. The last two times we had stock and bond markets down for an entire year, if you looked out just 2 years later, in each of those periods, a balanced portfolio, 60-40, was up more than 20%. And while that's not statistically significant, what's interesting is we've already had incredible negativity in the stock market and incredible negativity in the bond market this year.
Okay, and you point to Tom, but this to me is really a question of, can you bet on the grow before we get the slow?
Right. Well, the grow is already. The grow is the coming off of. It was
Pause.
Good.
1 sec. Did you just make that up? Because that's great.
That was like a haiku.
Well, that's essentially what we're asking: is can you bet on the expansion before we get any kind of slowdown?
I love that. That's awesome.
Okay, so we have to answer the question.
No, please do.
That's okay. So let's take a look along real estate. Right, which has already been in a recession. We've had manufacturing already been in a recession. We've had parts of parts of our economy like healthcare, right, negative earnings for the first time in 15 years this last year. Lots of these parts of our economy, 40 or 50% of our sectors, are going to be having very positive earnings relative to 2023. And then the average stock, which has gone virtually nowhere this year, has the opportunity to rise. One of the things we put into our portfolios is the most boring investment we've added, which is S&P equal weight. If 10 stocks have done well, you want to own the other 490. So I just think that this is where people have sort of missed it, is that we haven't seen the overall market rise yet. And that's what 24 is going to be about in terms of earnings.
So the double-digit percentage point gain that you think we can get next year, that's at the equal weight and not the market cap weighted index?
That's right.
Okay.
That's right. And I think that's the opportunity, is this rising earnings, because you've had large portions of the U.S. economy are coming out of a recession now. Their inventories are down. They've got to rebuild. They're not hiring. Wage costs are coming down. It's not about a landing. That's the other thing. Everyone's talking about this hard landing, soft landing. Forget about it. We're now in the situation where we're now beginning a normalization of markets back to sort of where they were like 4 years ago, pre-pandemic conditions, and we're going to be coming out of this in a grow mode.
Are banks structured well for that moment?
Have bank structure or our client structure?
No, are banks structured, as in the equities, the bank equities that have struggled so much this year off the back of high yields?
I mean, I definitely believe that the normalization of the yield curve is going to definitely change valuations for banks as a segment. I think that's more of a 12 to 18 month trade than it is a long-term opportunity. I do think that banks are very undervalued at this point.
I guess I'm trying to understand this perfect scenario and how much oil plays into it as well, given the fact that has been one of the reasons we've seen this disinflation narrative get some legs. How much does that factor in that we're going to keep seeing suppressed valuations?
Right. So I don't think we expected oil to move down as quickly as it has, and I definitely think it's supply, like you said earlier in the program. What we have, I think, discounted is the fact that globalization is still a major disinflationary force. import costs of goods coming into the U.S., both finished and unfinished goods, are negative 3.7% relative to last year. They are adding to the disinflation story. So between energy and import costs, you have this situation where you just don't have inflation on goods, and that, of course, translates into a better economic scenario. It seems like you're having trouble believing that that you could have a really good backdrop for markets.
No, what I find fascinating is just how much the narrative has gotten it wrong. Everyone's talking about deglobalization, how that would lead to inflation. Oil prices would be higher because their production just wasn't capable of meeting demand as all of the transition happens. And all of a sudden, workers are going to cost more to do the jobs that need to get done. And what we're seeing is all of the exact opposite. Isn't that sort of remarkable?
It is remarkable. The hiring for the last 2 years has been surprising. We've hired more people with slower GDP growth in the U.S. than in history. And now that's coming the other side. And the Saudis and OPEC wanted to keep oil prices higher, right? But they were unable to do so. They were originally willing to cut back production. So there's a lot of things where people think they can control market. And just to add one more thing, expectations in China and Europe are so low that they can't help but contribute, I think, to the growth story sometime in 2024.